And so if that's the thinking, then if you go back in time, what you should see if you look at recessions or the S&P 500, I mean, we have recessions on this chart, at least three of them. You can go back even further. What you would expect to see is that when the Fed cuts, the market goes up, and when the Fed raises rates, the market drops. Right? It's not at all what you see. So it's not the Fed that's causing the recession. These are two things, like it's the Fed reacting. I mean, ultimately, I think this is the misunderstanding that's occurring at the market level, which is that the Fed is going to determine whether or not we have the recession by their cutting or hiking. They obviously have an impact. If they do stupid things and rates were at 20 and they kept it there, yes, we would have a crash. That would be their fault. But when we're in this kind of uncertain period, what we see in the data is when you go back in time, the Fed always cuts kind of right before the recession happens. So you could say the cut causes the recession, but that makes no sense. No logical person would say that. So what's actually happening? These are two independent things. And ultimately what the Fed is doing is they're making their cut or their hike decision based on what they think this thing is going to do next. So it's not that the Fed is driving the market. In the near term, it will, because traders are speculating and they do what they do. But I think the reality that people are missing is no, the economy is on its own path. It's moving. And the Fed is trying to anticipate where it's going. And so they cut ahead of the recession, but they didn't cause the recession was happening anyway. And then the only thing you can then assume is that, well, the cut helped us. We didn't go as low because of it, right? You can never go back in time and figure out what would have happened if you didn't.